slide 6.
That happened. Hard.
Okay, are we good?
We're good.
Yeah.
Okay. So starting on slide 6 and just looking at the numbers there, you'll notice that in that summary, your Q1 return for 2026 was just a slight negative. Market value as of the end of March, 88.5 million, with just a loss of about 0.6 million. So I want to take a step back and reflect on maybe some of the comments we made at the beginning of the year. We started 2026 very positive on the outlook for economic growth, corporate earnings growth, as well as opportunities outside the US. SEI's view hasn't changed much. However, that is challenged by the geopolitical developments in the Middle East. So when you think about Q1 and that slight negative return, what really happened is that we did have a bit of volatility from multiple fronts. One is AI. AI remains a very dominant theme. And what we saw was a much more focus on AI disruption, winners and losers, but more of a focus on losers and particularly on software companies. The other key concern or source of volatility was private credit, and we'll get into more details in slides to come. So that was also tied to software companies. And then as by the end of Feb, we had the Iran conflict. So in combination and thinking about the significance of that, the markets were very resilient. So when you look at performance, it's just a slight negative, and even broad market performance, for the most part, it was also really just slightly negative. What really helped during that period is the strong diversification that you have in the portfolio, and that word will come up multiple times today, and we'll explain why it's important and why we have your portfolio diversified the way it is. So today, your portfolio has actually recovered quite a bit. So just for the month to date for May, it's up 1.4%. For the quarter to date, 6.7%, that's a plus. And for year to date, you are in positive territory, it's a plus 6.1%. And the market value is at about 93.5 million as of last Friday. So you've seen a strong recovery back. So we are in positive territory, but still faced by some of those challenges that I mentioned and were a source of volatility in Q1. When you look at your portfolios and when you're talking about the diversification, you notice that there was at least one or two funds in each asset class that had a positive return. So in your equities, it was the US Small Mid Cap Fund and the Global Managed Volatility Funds, but also our investment style was favored by value and low volatility factors. So those helped, and in terms of mitigating the underperformance and actually helping where there's negative performance, we were doing better than the benchmark. Fixed income, we did see higher yields and widening of credit spreads in Q1, and your core fixed income and limited duration funds actually did have a positive return. And then you look at your alternatives, which are a good diversifier in the portfolio, the private assets, private equity, those, the internal rate of return at 9.3%, positive on a time-weighted return as well. So experiencing and benefiting from the AI theme, particularly the GPA6 and GPA funds. So we'll touch on those as well. So you do have very good diversification in the portfolio that's helping during these volatile times. So that's, let's go to slide 8, market performance, broad market, and focusing our attention to that chart or bar graph to your right. More broadly, like I said, so the blue bar is the first quarter. You'll notice just slightly negative, except for the US large cap that was a little bit more negative, but we saw very strong performance in commodities and inflation-sensitive sectors as well, but better performance really came out of commodities. Then on a trailing one-year basis, still very strong across broad market segments. When we go to slide 9, so oil prices have been at the center of the volatility we've been experiencing on and off, clearly because of the Middle East conflict. And we like looking back at history on similar events and trying to set expectations, so think about expectations. So when you look at the line graph to your left, this shows the dependence of the global economy on oil and similar events around the early 70s to the late 70s during the Arab embargo and Iran revolution. You can see that the world was a lot more dependent on oil, with China, of course, being a lot more dependent compared to other economies. But you look at that today, not so much. And that is because we do have alternative sources of energy. Now, the key thing as well is the disruption as a percent of global supply. In past events, it was actually less than 10%. With what's going on today with this current Iran conflicts, it's at about 20%. But you think about what's happening, it's actually been well managed, relatively speaking. We've had some... yeah, I mean, we've had some shock absorbers. They're not sustainable. You've got the US, of course, the oil exports have gone up. You've got China that has limited its imports. You also have, different regions tapping into reserves. So that's helping, but again, not really sustainable. And given what we've had today, I mean, we're just crossing our fingers that this doesn't linger for very long. But like I said, manageable and helping a little bit. So slide 10, our views for the economy and really the markets as well. Like I said, we started with a very positive outlook. We've retreated a little bit when it comes to interest rates. Markets had priced in 2 cuts for 2026. SCI position was neutral. We're still neutral, but what we are expecting now is really perhaps just unchanged, but also a chance for a hike, not just for the US, but also other major economies other than Japan, I'd say. And then inflation, we've had a stance of higher inflation for longer for different reasons. It's been different from consensus. I'd say where we are today, we are perhaps in line, much more in line with consensus because of what's going on with the war. So inflation expected to be heading higher, particularly the headline inflation. Core inflation is also ticking up higher as well. And then you have the economic growth. The retreat there, not as much. And that is because when you think about the US economy, it's shown a lot of resilience. Think about this decade, starting in 2020, we had the pandemic, we had the Liberation Day, we also had the Russian and Ukraine war, and today we have the Iran war. And given that resilience, supported by the fact that the government is spending, and we have significant spending also coming out of these AI themes. So that dominance of AI is not something that's enjoyed by other countries outside the US. So while the economy is expected to be slower, that's also from like a very strong place. Any questions before we go to the next section?
No.
Okay, so this next section is the asset allocation and portfolio positioning. I'm sure there are concerns, of course, there are concerns because you've expressed those to us about what's going on and what can we do to help, the portfolio, maybe even fears that there could be a crash. That's actually what came through. So when we design the asset allocation and implement that asset allocation, we are thinking about the long term. Your portfolio is actually designed, has a longer term horizon based on the IPS. So that's what we take into account. And because nobody really has a crystal ball, we design a portfolio that's expected to weather a variety of market and economic environments and provide consistent risk-adjusted returns. So we take into account your goals, objectives, liquidity needs, and risk tolerances to design that strategic asset allocation. It's long term, so we don't change it much, but at least annually we review it and make changes. When we are implementing that asset allocation, we do it through what we call functional asset classes. We want to make sure that every strategy you have in your portfolio, every asset class that you have in your portfolio has a role in the portfolio. So for example, you do have private assets that we're going to talk about today. That asset is there to diversify risk and enhance returns and provide a smoother return experience over that longer term horizon. So we are targeting the actuarial assumption, which I believe is 6.75% percentage points as the investment objective. And the performance measurement for that is over a 3 to 5 year period. So we want to make sure that we are designing and modeling the portfolio for that. So slide 13, I'm going to go into a little bit more detail on that modeling. It has 3 key steps into it. There is the capital market assumptions, then there is the portfolio construction and the portfolio simulation. So the capital market assumption factors expected returns, volatility, and correlation of asset class returns. And then the expected return is taking into account alpha, real return, inflation, and volatility as well. And we model all of that together, come up with estimates. In the portfolio construction process, we are looking at history. We are also looking at major regimes like the global financial crisis. We are factoring all of that. We are stress testing across all of those regimes, and then incorporating your specific investment objective to actually customize a portfolio that's just unique to you. So that produces, the result of that is a normal distribution of outcomes and with the asset allocation that's to your left on slide 14. So when you see that, when you look at slide 14 and look at the metrics at the bottom, so these are the targets that we are managing to. So in the short term, so our capital market assumption framework is on a 5 to 10 year basis. You look at the short term, so the target there is 7.5% equilibrium. Think about that as a bit of more longer term, 8.4%. The standard deviation, which is you can also translate that to mean risk or volatility, is 13.8. And when you look at that expected return outcome or distribution of outcomes, so a poor scenario for the current portfolio on a short-term basis, minus 12.8%, a good scenario about 32.4%. Again, we are targeting the median. Typically at any one given point, you're just going to experience one of those returns. And each of these are 1 to 2 standard deviations, but mostly one standard deviation is what you'd really experience. So based on what I've said, given that the asset allocation is strategic long-term, we are not making a ton of changes. Now, that doesn't mean that we are not really making changes within this portfolio. So we have another layer of diversification, the strategies that we implement that asset allocation, those funds. So we are a manager of managers in a sub-advised structure. So any one fund has 3 or 4 managers. Our portfolio managers are actually managing these portfolios based on our investment philosophy, which focuses on alpha alpha sources or factors that have been studied and proven to outperform over the long term. So we are identifying the best skilled managers, for example, for value, quality, or momentum. So for example, in one fund, you have a manager that's really the best skilled in managing to value, one that's the best skilled in managing to quality, another that's best skilled in managing to momentum. So the portfolio managers are making those tactical changes based on what's going on in the markets and the economy, but the managers themselves that we've hired are a lot more active and making a lot more tactical decisions within those particular funds. So there's a lot that's going on underneath the portfolio that we don't talk about every time when I'm here, but just so you know, that's what's, so you're covered with what's going on with the markets at present. So when you look at slide 15, it shows the strategic changes that we've made in the recent past, going back to 2015. These are the annual strategic asset allocation changes to really position ourselves and your portfolio to weather, those different economic and market environments. And then slide 16 provides our broad portfolio positioning views based on the current environment. So more broadly, we are positive on risk assets and commodities for 2026. We don't expect a downturn in 2026 unless things change in the second half. Specific to equities, I talked about those the alpha sources. So we continue to maintain strategic positions, but we have a bias or do favor value. So there's going to be a tilt within equities for value. We like emerging markets equities, and one for the relative valuations compared to developed markets, but also their ability to leverage economic growth more broadly. Fixed income, we've been defensive fixed income for a while, and we continue to maintain that position. However, given I'd say maybe the opportunities that we think concerns with private credit is presenting, we are observing that and could potentially add risk to credit selectively. We've also avoided the longer part of the curve, and that's because of concerns with debt in the US. We've been neutral, but what we are also doing is actually adding a little bit of duration for you. So with your core fixed income, it's about maybe today 0.2 years longer than the benchmark. And when it comes to foreign currencies, we do like emerging markets currencies, and we've been playing the carry trade there. So just based on the stuff that we are doing, and this is just more broadly in terms of how we are positioning the portfolio. Slide 17, a good slide for a time like this when clients are very worried about volatility. As active managers, I might have mentioned this in the past, we actually like volatility. It's not quite always good for returns, but it's good in the from the perspective of it does present mispricings that we can take advantage of, dislocations that we can take advantage of, and improve returns for those particular funds or strategies and for the portfolio overall. So we've planned for these through what I took you through, that strategic asset allocation and the diversification. When you're thinking about risk or hearing about concerns in the headlines, a lot of times that has already been priced in by the markets. Markets tend to be very forward-looking, and to be able to make any tactical decisions, you really need to be disciplined. And for us, for a fund like the dynamic asset allocation, where we implement our active views, we actually formulate themes and think ahead of that and make positions or invest in positions as in advance or in a timely manner. So That's, I mean, the tactical decisions, like I said earlier, happening within the funds themselves, and in managing risk, really what has proven to work is diversification. So you have that in the portfolios, and we always, monitor that and make sure that we are, you are diversified accordingly. Any questions?
Bob, you were on the board when things took the turn south and what was it, 2008 or late 2008, 2009? Did we
Yeah.
just stay the course, do you know, with
Yeah.
what we had?
That's usually worked.
Yep.
We have position wall going in and just sit tight.
Yep.
Mhm. Good. So the funded status down as of March 31st compared to year end, that is really much more because of the asset performance. It's at about 96.7%. Net change in market value, slide 21. So for the 3 month net cash flows of 804,000, there was net loss of about 591,000. Again, you've recovered from that position. Then we go to a little bit, I'm going to be a little bit more thematic on the next few slides. So looking at just the year to date, the 3 months as of this time period that we're reporting here, and looking at the diversification you have in your portfolios within equities, it's both domestic, that's the US, and internationally. Within the US, diversified across market caps as well as across passive and active. Some of the changes that we've made in the current market environment, we did about, it's been 3 years. We do have the US Equity Factor Allocation Fund that we've been using to diversify the concentration risk with the S&P 500. We introduced active management in the small cap because we think it's a good time for that. And as you can see, that small mid-cap fund was actually a positive performer for the quarter. And then the international, fund has struggled a little bit relative to the benchmark, and that is because of that quality factor. It's not just for the SCI funds, but quality has been struggling more broadly as we see more speculative names outperforming. Slide 23, global managed volatility. This is a fund where it's actually defensively positioned and tends to do well during downturns. It has less downturn capture, and as you'd expect, during the quarter, it did well with a 3.3% return. Then fixed income, very good diversification. You have return enhancing with your high yield and emerging market debt that have done very well over the longer term. If you look at your 1 year and 3 year, those are very strong returns. But most of the assets within fixed income are in core fixed income. That's an intermediate bond fund, about 6 years in duration, and that's really the stabilizer for the portfolio. So typically you'd expect most of your assets there, and again, holding up well, just a slight positive return there. Then you have your alternatives across the secondary opportunities, GPA 6 and 7. So a number that I'll come back to is its current allocation at 3.9%, and then the dynamic asset allocation fund that did not quite do well during the quarter, but longer term and for the year, for 2025, it did perform well. So the next slides are calendar year returns, so I'll skip those and get to private assets. Any questions on performance so far?
The dynamic asset allocation fund has typically kind of beat the other returns. So do you know what happened, why we're not doing so well this quarter on that?
Yeah, so this fund, it's one where we implement our activities, and it actually overlays the S&P 500. And so some of the key themes that we have there are stickier inflation. So we have some some CPI swaps position there. We also have a theme on global debt dynamics, so the differences across the different key economies. We also have so some hedges, and I think I'm forgetting one of them. Jake, can you remind me? Monetary policies.
Yeah, so in the DAA fund, Dynamic Asset Allocation Fund, our main thematic position is something called a yield curve steepener. So it's essentially thematic view that the yield curve, the treasury curve, is going to steepen. Shorter term rates are going to continue to come down and longer term rates are going to stay high. So when we had that, when the conflict arose in Iran, and the Strait of Hormuz was constricted, there was a supply shock around commodities and concern around inflation. And originally, there were interest rate cuts priced in for the beginning of the year. And as rates rose, the yield curve flattened. So the short-term rates rose, long-term rates stayed pretty high. And that went against our positioning there. Generally, we think that trade is overdone. So we have kind of leaned in a little bit further. We think there's still room to benefit from that steepening positioning. So that was, kind of a short-term element there, but we do still have conviction in that position.
Yeah, so that's the play on the global debt dynamics. So some of the changes that we've actually made in the last few weeks to this fund, so talking about what are we doing? So we did actually add a broad basket for commodities, as well as broad emerging markets exposure in that particular fund. So just recently, in the last few weeks, in line with our broader views.
Okay.
Thank you, Jake. So private assets, let's start on slide 28. And just for the new people, and it's always good to go through these reminder. So your investments are this is private equity, secondary opportunity, GPA 6 and GPA 7. And the reason that you have these three is because we do these, we try to get to the target through what we call programmatic allocation, like committing to different multiple vintages over time. So you have the 2022 vintage, 2023, and 2024. They are all in their early cycles, but of course doing very well, and I'll speak to that shortly. The commitment amount for the secondary opportunity is 2.5 million. The same for GPA 6 and GPA 7 was only 700,000. So 58% has been called for that secondary opportunity, 60% for the GPA 6 and 48% for the GPA 7. That's under that column that has the title percent funded. And then the unfunded is what is yet to be called. There has been some distributions, which is about 373,000. We report on a lag, so the valuation dates for this is December 31st, 2025. And then the adjusted valuation that takes into account your unique cash activities is a total of 3.5 million, which is that 3.9% I was talking about, and a strong internal rate of return of 9.3%. So the good performance that we are seeing with GPA 6 and GPA 7 so far is emanating out of some key investments we've made that are benefiting from the AI theme. One of them is Anthropic, a big name that you've been hearing about. We got in very early. So the performance that we are seeing is largely due to financing markups, not realizations yet. But it just shows, what it really shows here is that it's this layer of diversification across different economic environments does help the overall program. So that's what's going on there with the secondary opportunity fund. It's really just exits. Again, these tend to be early because these are mature companies. So slide 20, the next few slides are high level, and at some point we'll bring in our a portfolio manager from our team that can get into greater detail if there are questions here. But this slide really, gets into maybe some key elements of why or some considerations we take in private market investing. In your case, like I mentioned earlier, the role in the portfolio is to diversify risk and enhance returns and help provide that smoother return experience over longer term. There are usually some key challenges or concerns with clients. We do take that into account. For one, the asset class itself is it's actually illiquid and has a quite a bit long investment horizon, up to 10 to 11 years. So very important to get it right. Also, manager return dispersion is usually very high. So we have taken all of that into consideration. Sizing, for one, for you, it's only a 5%, so that illiquidity is only to 5% of the portfolio. And right now you are only at 3.9%. The rest of your portfolio does have a daily liquidity. And then the way we implement the investment very much in line with our diversified approach. So for one, it is a fund of funds, and it's diversified across multiple sectors: buyouts, venture capital, and opportunistic. That opportunistic bucket is where we have private credit. We also have core investments and secondary investments as well. It's also diversified by geography, North America and Western Europe, but also by type, primary and secondary investments. And our investment process here and philosophy really focuses on the lower middle market. And I'll discuss that more as to what's going on in the current with the current concern. Then slide 30 is even what I laid out in the previous slide. It's very, very important to have a partner that has been doing this for a long time and has a very disciplined process. And SEI is a great partner in this. We've been doing this for a very long time. We have very good relationships with some of the large top tier managers, and we also have seats on the advisory board, and this helps us with deeper insight and information that helps in risk management and governance. So slide 31, the concerns or the headlines that you're hearing today. So what's driving that? There are multiple issues. So the key one is really the illiquidity that we talked about. So historically, this has been a space that has only been accessible by institutional clients. However, over the last few years and just the growth of the asset classes, retail clients started accessing it. And the way that was offered was through vehicles that would enable it and provide some type of liquidity. So these vehicles are called evergreen funds or interval funds. And essentially what they mean is that you can have maybe a 5% or 7% liquidity periodically on a quarterly basis. But in reality, it quite doesn't work out because there's a mismatch of assets and liabilities. It does take time to value the underlying assets here, but when you have a situation where you have more clients wanting their money out and that 5% doesn't cover it, it presents a crisis. For example, with some of the funds that are in the headlines. The other issue is the non-performance of some of these loans, and in particular, where they have a sponsor for the assets that, or rather the funds that you're invested in, they're very, very different. For one, we target that small to middle market. These funds are targeting the larger buyout funds that are highly levered and where credit is a commodity, you need lower interest, less covenants, and the lender isn't as protected. So for us, what we really seek, again, low leverage, low loan to value ratios, and we have more covenants in our funds than just the average or what's out there in the market. We are also looking for alignment of interests, and more specifically, as an example, to have these, to have a partnership with management of these companies and developing metrics upfront on how there's going to be an optimal exit. So that makes us very different in terms of what we are targeting to what's actually getting the headlines. Then slide 32 speaks to the importance of manager selection. So we look, this shows the dispersion of returns across the different major asset classes. You have large cap equities, global bond, US core real estate, US non-core real estate, global private equity, global venture capital, and hedge funds. And this is for a 10-year period. Of course, it's lagged because you have to take the lagged valuation of some of these illiquid assets. But the key thing here is that you'll notice that global private equity, the dispersion is actually very high. And you see where the median sits. So for you, what really is helpful and useful, and we think works, is that strong diversification, having an experienced manager with a disciplined investment process, a strong manager selection program, and also the diversification that we talked about across economic vintage environments, and just that fund of funds approach also does help reduce the manager dispersion and vintage risk. So while there's that headline going on and it's concerning, we don't think it's systemic, but we also think that our approach has insulated us, at least for now, from what's going on.
Okay.
So I'll have, I know I've talked a lot, but I also have Jake, who's also a very a key partner in my day-to-day, in the day-to-day of this portfolio. I'll let him chime in on anything that I've covered in case I've missed anything. Jake, do you have anything to add?
No, not particularly. I think it was pretty in-depth presentation, and I would say within that private credit conversation, we've had that on our radar for a number of years, and there was some concern with a lot of those funds having a lot of dry powder, essentially money to put to work, and specifically those private credit funds not having the underwriting standards that large banks will typically have. So that was kind of a concern, and is an area we're relatively underweight within the diversified private equity sleeve. So I do think we go at that particular asset class with a really keen amount of due diligence, and that has been the area of private equity in the headlines lately, and the private assets in the headlines lately. So it's something that we've had our eyes on for quite a while now.
And we don't have actually a dedicated strategic allocation to just private credit. The only place we have it is within the private equity or private equity funds as an opportunistic allocation.
Okay. Any questions for Florence?
So there's an appendix that has a ton of detail. If you want to go through at your leisure, the detail for each fund, we have that in the appendix.
Definitely sold on the value of the diversification and its ability to absorb all of the stuff as you go. Well,
Okay, well, thank you, Florence. If there are any other questions for Florence, feel free to stick around as usual, but if you need to get going, you can exit while we're working through the rest of our agenda. So
I'll stick around a little bit.
Okay.
Thanks,
So
everyone. Take
moving
care.
on. Sorry, Jacob, did you have something?
No, just saying thank you.
Thank you.
Thank you. Bye.
So moving on, item 3B is the Fund 731 financial reports, Ben.
Yep, page 80 of the packets. Total assets from March 25 were 80.6 million. This year's March month-end assets were 88.7. That's an increase of just over $8 million. The net of revenues and expenditures at March 25, we're showing a surplus of just under $3 million. This year's March month-end is 3.7 million. Attached are the account balance reports for your review.
Any questions for Ben on the financials?
None from
See people looking, so I don't want to rush, but looks like we'll move on to the update on the change in beneficiaries.
You want to take it away, Sam? It's, the first one is James Cook has passed away. His obituary is attached, and Larry Withrow has also passed away.
Larry was I think a spouse of Virginia who worked here.
Yes.
Okay. All right, any questions on that? If not, that's it.
Sorry to hear of their passing.
Mhm. Old business, there is no old business, new business. Moving on, we have these Fund 731 invoices paid. Looks like that's on page 90.
Page 90. So total payroll transactions were $147,950.26. Total retirement system was $27,575. General government was $4,027.03. Total to approve is $206,560.29. That is the report.
I would move to approve the payment of invoices paid from the retirement system fund in the amount of $206,560.29.
Support.
Okay, moved by Michael and supported by Emily. Any other discussion? All in favor, say aye. Aye. All opposed, motion carries. Rollover contribution. Contributions, plural. Page 8, page 93.
Page 93. So this is Elisa Billman, former deputy clerk. Attached is her information. We're asking for approval of the $4,027 increases.
I move to approve the rollover of accumulated contributions to former employees as presented.
Support.
Nope.
Emily?
Yep. Moved by Michael, supported by Emily.
The good
Any
news
further
was, the
discussion?
roll, we're not a.
Yes, it is.
That's right.
So I think that's the discussion. All in favor, say aye.
Aye.
All opposed, motion carries. Okay, and I think then there is a request to go into closed session.
I would like to make a motion to enter closed session to review and approve final average compensation.
Support.
Okay, all in favor, say aye.
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 All opposed. We will move into closed session.
Thank you.
All right, so the first is a resolution final service retirement for Julie Wolstead. Say it again. Okay, I've been saying it wrong for 10 years.
I'd like to make a motion to approve the retirement for Julie Lustig.
Any other discussion? All in favor, say aye.
Hi.
Okay, next, the resolution for final service retirement for Bunny Wheeler.
I'd like to move to approve the retirement for Bunny Wheeler.
Any other discussion? All in favor?
Aye.
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 Sorry, I did not do that very well. Okay, and then finally, the resolution for the final service retirement for Claire Gillespie.
Move to approve the retirement for Claire Gillespie.
Support.
Okay, moved by Emily, supported by Michael. Any other discussion? All in favor, say aye.
Aye.
All opposed, motion carries. Okay, 2026 MAPERS Conference, Spring Conference. Tom, did you want to talk about this or do you want me to
I
talk
just want to
about it?
remind everyone it's coming up this weekend. That we have historically sent many people from the city to this, so it's a great conference.
Yeah. Bob, are you planning to attend?
No,
Michael?
Negative.
Sam? Megan? Okay,
Are you going? Okay, so the world.
Thank you,
Is
Sam.
that correct?
yep. And do we know if Harper? Thank you. Nope. Okay.
Okay.
Where are you going?
I doubt it.
She's not gonna be back, is she?
Yeah, she'll be back. She'll be just back.
Okay,
I don't think she's gonna turn around and leave again.
probably not. All right, moving on, the next pension board meeting is August 9th at 1:30 PM,
Yep.
correct? Okay. And with that, is there any public comment?
August 9th.
August 9th is a Sunday.
Oh,
Yeah,
sorry.
that's okay. August 10th, however, is a Monday, and I do have a hold for the employees
11.
retirement system board meeting.
Okay,
It's also gonna be 2026.
we don't have a motion for that, but we'll get it corrected in
Yeah.
the packet.
Is there any potential for moving that? I have a travel arrangement and I actually will be returning on August 10th.
I would think that's early enough.
I think the board can make that decision.
Well, I'd like to make a motion that we as a board consider rescheduling the August 10th meeting.
Do we want to figure out dates right now? What we have everyone?
Sure. Is there a need, Ben, to go earlier rather than later, or from your perspective?
We have to let SCI know. So we'll have the reports by then. August will be for June month end.
Okay,
So
would it make sense for us to make a motion to ask you to find another date that works with SEI?
sure.
I would say we don't want to move it up. Part of the reason we moved it to where we did was because of the private equity and for them to be able to give us there's always a lag delay in getting those
Yeah.
reports. So I would say look for an availability the week of August 10th for the
And,
meeting.
and I appreciate the flexibility in scheduling for me. Any day after the 10th is my return date. So literally if we had it on Tuesday, the 11th, for example, I would be here. So
Okay.
Okay.
it's just that Monday that doesn't work.
11 works for me.
Yeah, that works for me. The following week, I am hoping to plan a vacation. That's the following week and it is not yet planned.
Thank you.
I'll shoot for the 11th through the 14th.
Yes,
Mhm.
Correct.
Okay,
beautiful.
Yeah,
or I'll reach out.
I appreciate
thank you
it.
for doing that.
Was there a motion support or is that just direction?
I think it's direction. Unless you tell me we should do that. Okay, no public comment. Any trustee comment? All right. And there's,
Motion to adjourn?
thank you, yes.
Support.
Emily and Michael, any other further discussion? All in favor, say aye.
Aye.
Motion carries. Thank you. That was a record meeting.
That was well done. Thank you, guys.